Hello and welcome to the look ahead for Friday, the 4th of July with me, Fiona Cincotta, Senior Market Analyst at City Index. So 4th of July, it is indeed Independence Day in the US. So US markets will be shut. We're expecting volumes across the rest of global indices and currency is likely to be quite low. As far as economic data is concerned, against the calendar is very light. Even in Europe, we've just got German factory orders and Eurozone PPI inflation. Bank of England policymaker Alan Taylor is also due to speak. So just kicking off with the German factory orders expected to come in negative 0.1 month on month in May. That's down from 0.6% in the previous month. As far as PPI is concerned, inflation at wholesale levels, that's also expected to moderate down by 0.5% month on month in June after falling 2.2% in the previous month. So we are seeing a sign that that sort of drop in inflation is starting to moderate. Also, let's not forget that we've seen CPI fall back to the ECB's 2% level. Weak PPI is considered a lead indicator, so it tends to point to a further weakening in CPI inflation as well. Now, the data comes, this is the chart Euro US dollar I've got up here. Now, the data comes after we've had the PMIs for Europe out today. We did actually see the Eurozone service sector return to growth, albeit modest growth of 50.5 in June, up from 49.7 in May, and that's above the 50 level, which separates expansion from contraction, but as I said, only just. This is the Euro US dollar. Now we can see that there has been a little bit of a fall off in Euro US dollars today. That's to do with a little bit of dollar strength that we've seen on the back of those non-farm payroll reports, which actually came in stronger than expected at 147,000, well above the 110,000 forecast, and the unemployment level in the US also unexpectedly fell to 4.1%, down from 4.2%, defying expectations of a rise to 4.3%. So the data caught the markets by surprise, that as lead indicators actually pointed to a weaker non-farm payroll report. So we've seen a strengthening in the US dollar, supporting the view really that the Federal Reserve is unlikely to, or very unlikely to, cut interest rates in the lights just turned off in the July meeting, which is coming up now in this month, with the market pricing over a 70% probability that the Fed will cut rates in September. So if we're seeing this data tomorrow, as I said, we're not expecting volumes to be very high at all. US dollar, as I said, US markets will be shut the stock markets will be shut for the public holiday. Volumes in USD are expected to be light. As far as this technical picture here, we're still within this upward trend, upward channel, which we've been trading in since early May, just hovering around that 118 level, 4.5-year high. Buyers are going to need to break above that to get to the 119 level, fresh 4.5-year highs, fresh 4-year highs, sorry. On the downside, support, seeing it here around the 116, 117 level, which is the midpoint of that rising channel. And then here's quite an important one at the 116, which is the highs that we saw around mid-June and also at the end of April. Just also having a look here at the FTSE. As I said, we've got Alan Taylor, the Bank of England policymaker, who will be speaking. Interestingly, Alan Taylor spoke this week and did actually warn over a hard landing for the UK economy. Now, the UK economy is certainly facing challenges, not least in a fiscal level, as we've heard with the as far as the U-turn is concerned, with welfare spending cuts, which were sort of really reined back, and so that's, we saw the concerns over what would happen with Rachel Reeves. Now today, Keir Starmer has actually backed Rachel Reeves, which has seen a return in demand for gilts, which had dropped sharply yesterday, along with the pound and the domestic FTSE index, the FTSE 250. This is the FTSE 100 that we're looking at here. It's slightly more international base than the FTSE 250, so it doesn't tend to respond as much to domestic issues, although it can still respond to domestic issues. But we can see that's the candle for yesterday. We saw a little bit of volatility on the back of those concerns that Rachel Reeves may be leaving. But as I said, Keir Starmer's backed her today, so that's looking unlikely. We've also seen the gilt demand return, as he said that he supports the government's fiscal position. As far as data is concerned, we've had PMI data out today, showed that the service sector grew actually at the fastest pace since August 2024. So that's some encouraging data, despite these warnings from Alan Taylor regarding a hard landing. It'd be interesting to see what he has to say tomorrow. But I think what he's referring to here is the outlook as far as employment is concerned. And we have noticed, and we have heard other Bank of England policymakers, including Bailey, warn over the outlook for the jobs market, which is seeing some softening owing to the increase in employers' tax on national insurance in the October budget. We are seeing some weakening in the labour market already. Obviously, if we got a tax hike potentially coming in the autumn budget this year as well, that could really hurt growth. And it would be considered deflationary, which could mean that the Bank of England is going to cut rates further. So as far as levels to be watching, we're just really struggling around this 88,000 level. This is the level we've seen this struggle before briefly rising higher to that all-time high. It's struggling around the 88,000. Buyers are going to need to push beyond this level in order to get up to that the all-time high, which was the 89.10 level that we saw earlier last month, sorry. On the downside, failure to really break above that is going to bring this level here, 87.25, back into focus, which is also the 50 SMA. A break below there is going to create a lower low towards the 86.50 level. So I hope that you've liked everything that we've seen today, and if you have, then please do give this video a like, and for more videos like this, please do subscribe.